Have you ever wondered how lenders decide whether to give you a loan or not? It all comes down to a process known as underwriting. This is the method used to evaluate a potential borrower's creditworthiness and determine the risk they pose to the lender. Let's dive a bit deeper, shall we? Imagine underwriting as a meticulous detective who's responsible for investigating a borrower's financial history, income, and credit standing. The underwriter's primary goal is to assess how likely it is that the lender's money will be repaid, and, crucially, whether the borrower has a track record of defaulting on loans. To start the investigation, the underwriter reviews the borrower's credit reports. This review helps to determine if the borrower has a good credit history and whether they make their other payments on time. Next, they perform some specific calculations. They examine the borrower's employment history, pay stubs, and income, and compare that to the borrower's outstanding debt. This analysis helps the underwriter determine the borrower's financial capacity to make the loan payments. The underwriter then turns their attention to any collateral being used to guarantee the loan. Collateral is an asset that the lender can sell to repay the loan if the borrower defaults. The value of this collateral is a crucial factor in the underwriting process. Now, lenders also require borrowers to provide proof of income. This evidence, which may include pay stubs, tax returns, or bank statements, helps to determine if the applicant has a stable source of income to repay the loan. Lenders then calculate the debt-to-income ratio, or DTI. This ratio compares the borrower's monthly debt payments to their monthly income. A lower DTI ratio indicates a lower level of debt relative to income, which is generally seen as more favorable. When it comes to businesses applying for loans, the process is a little different. Lenders review financial statements, including balance sheets, income statements, and cash flow statements. These documents provide insight into the company's financial performance, profitability, and liquidity. Lenders also calculate the debt service coverage ratio, or DSCR, which measures the company's ability to cover its debt payments. It's the ratio of the company's net operating income to its debt obligations. A higher DSCR is usually viewed as more favorable. Finally, it's important to note that lenders must adhere to various laws and regulations, including the Equal Credit Opportunity Act and the Community Reinvestment Act, to ensure fair and responsible lending practices. In summary, underwriting is a detailed process that involves reviewing a borrower's credit history, evaluating their income and debt, assessing any collateral, calculating key ratios, and adhering to legal requirements. It's a critical step in the lending process and plays a significant role in determining whether a borrower is approved for a loan. So next time you apply for a loan, remember, there's a meticulous detective at work behind the scenes, making sure everything adds up.